Here's how the budget is looking at the mid-year mark, in 7 charts. The $5.8 billion drop in the 2017-18 underlying cash deficit compared with the original May budget is due more to higher revenue than lower spending. Receipts are higher by $3.6 billion and payments are lower by $2.1 billion. The higher receipts reflect the stronger economy, which implies higher company tax, up $3.2 billion, and superannuation fund taxes, up $2.1 billion. Receipts would have been even higher if not for stubbornly weak wages growth which, despite stronger employment growth, has tended to dampen individuals' income tax receipts. These are in fact down by $0.5 billion. The estimates of GST and other taxes on goods and services remain unchanged since the budget. The lower payments of $2.1 billion are driven by several changes having opposite effects. Some of these are: there is not much change in the net debt projections relative to those in the 2017-18 budget. Net debt is $11.2 billion lower at $343.8 billion in 2017-18, around 19% of GDP. Debt stabilizes in 2018-19 and starts to steadily decline thereafter to about 8% of GDP in the next 10 years. The lower deficits as a share of GDP are obviously reducing debt, but one factor tending to increase debt is student higher education loans. These are projected to increase by 32% from $44.4 billion to $58.8 billion over just the next 4 years. The economic outlook continues to be a puzzle. National output of goods and services, real GDP, is expected to grow slightly slower in 2017-18 than the budget forecast, 2.5% compared with 2.75%. However, this is an improvement on the 2% achieved in 2016-17, and it is expected to increase further to 3% in 2018-19. The economy is being driven by strong global growth and strong domestic business investment. Australia's major trading partners are forecast to grow, meaning real GDP growth, at a weighted average of 4.25% in each of the next 3 years. Wages and household consumption are the puzzle. They are not growing as fast as expected from the stronger than expected employment growth, up 0.25% on the budget to 1.75%, and lower than expected unemployment rate, down 0.25% on the budget to 5.5%. Household consumption growth is down 0.5% on the 2017-18 budget forecast to 2.25%. This has in fact become a global phenomenon due to higher costs and job insecurity from the forces of globalization and automation. Commodity prices are notoriously volatile and hard to predict, yet they are critical to the budget forecasts because they impact the revenue of resource companies, which feeds into company taxes and other taxes. Iron ore prices are assumed to remain flat at $55 per ton over the forecast period, as in the budget. This forecast is almost certain to be wrong because iron ore prices never stay flat for long. The problem is that we can't say in which direction it will be wrong. The same applies to thermal coal prices, which are assumed to be flat at $85 per ton, which is again consistent with the budget forecast. Australian taxpayers continue to bear most of the burden of budget repair.